Hi, welcome to Retiring Well. Folks, I got a great show for you today. We're going to talk about systematic risk. We're going to talk about the effects of low oil prices, 7 mistakes people make when choosing an advisor, what are orphan accounts, and then what are ABLE accounts, ABLE accounts. So folks, I got a lot for you today. Stay tuned.
Retiring Well, brought to you by Centennial Wealth Advisory, financial advisors specializing in retirement planning and serving all of Northern Michigan. Retiring Well, helping you plan for a successful and comfortable retirement. Retiring Well, plan to retire well.
Have you ever heard that saying, all ships rise and fall with the tide? Well, in our industry, this is what we call systematic risk, or beta, which I'm going to explain here in just a minute. So here's the idea. Let's say that I'm in an index fund that's tied to the S&P 500. Okay, this is an index fund that basically owns the S&P 500. Now, if I'm comparing that with the benchmark itself, or the index S&P 500, you would expect that index fund is going to go just like with the market, right? So if you see the S&P 500 rise, 2-3%, you're going to see that index fund rise 2-3%. For the most part, right? Think of a mutual fund that's made up of large company stocks. If a large portion of those stocks are the S&P 500, you would also believe that if the S&P 500 went up 2-3%, that most likely that mutual fund invested in the same would rise about the same. This is what we call systematic risk. The idea that that your portfolio is going to be pretty much going with the market. Now, that's a good thing if the market's cooperating. If I see the market do well, and I'm watching that benchmark, I know my portfolio did well, right? But what if it's the opposite? What if I'm watching, the market going down? I could probably expect my portfolio to be going down right along with it. Now, the ideal thing would be to have it go up with the market, but not have it go down with the market, right? Now, we have the ability to get behind any portfolio and actually find out what its beta is, okay? B-E-T-A. What it is you take a beta of 1.0, and that means that portfolio is basically going right with the market. If the market goes up 2-3%, you can pretty much expect that portfolio to go up by 2-3%. If it's down by 2-3%, you should expect it to be down by 2-3%. Now, a beta score of less than 1, okay, maybe you say it's 0.8, means that it's going to be less riskier than the market. So market's up 2-3%, yours should only be up 1-2, all right, and vice versa on the downside. Now, a beta score of 1.0 or more means that the portfolio is more riskier than the market. So it's going to possibly do even better than market, but probably do even worse than the market. So knowing the score is very important, because if you have a well-diversified portfolio and at the end of the day it has a beta score of 1 and it's pretty much just tracking the market, well, if that's what you want it to do, that's a good thing. But if it's on the downside, if it's not what you want to do, maybe that's a bad thing. So I encourage you, if you're somebody that doesn't know that score, doesn't know how your portfolio would operate as it's compared to the market, then give us a call. We'll gladly analyze that portfolio and tell you what your beta score is.
If you're retired or soon to be retired, let us help you plan to retire well. Centennial Wealth Advisory specializes in retirement planning and has offices in Traverse City, Cadillac, Petoskey, and Gaylord. We'll never pressure anyone to become a client. Our goal is to inform and educate. Simply schedule a meeting at one of our Northern Michigan office locations for a free, no-obligation retirement review.
Hi. In this segment, I want to talk about low oil prices and how specifically they affect the market. Now, I think it was just about last year, we just became a net exporter, meaning we produce more oil than we consume in this nation. That's now allowing us to be energy independent. We are no longer relying on what's happening overseas and the like as far as it has to do with oil. Now, a lot of that, the reason we've become that is because of new technology. Now, I know this is very controversial with directional drilling and what they call fracking. I mean, this is literally with fracking, they're putting chemicals in to expand shale so they can, get more oil out. And I know that's controversial, but from a technology standpoint, it has certainly allowed us to ramp up our production. Now, low oil prices, for the most part, benefit anything that has to do with transportation. Airlines, I mean, it's tied to airline fuel, so, that's a lower cost for them. Trucking. Anything that has anything to do with transportation where it's using fuel, it's going to be good for them for having lower prices. Now, who does it hurt? Hurts oil companies, right? Because when the price of the barrel is low and they're not able to get as much for their production, it hurts them. And oil companies who are not doing well and ultimately end up in bankruptcy, then that hurts banks, right, for the ones that actually loan to them. Now, in our country, we've got a lot of diversity. We're not like Saudi Arabia that's relying solely on oil production as a major part of its exports. We're pretty diverse here in the United States. Last I knew, the energy sector, the oil sector in our economy was like just a little under 4%. So that makes us very diverse. So even when that sector gets hurt in our economy and there's a loss of jobs and the like, it is still a very small part of the overall picture. Now, who really benefits from this? Well, consumers. I mean, you go to the pump. I think about a month ago, when oil prices plunged down to $40 some a barrel, the price of gas got to be under $2 a gallon. That I haven't seen that price in quite some time. And when you have lower prices and there's lower price at the pump, what happens? Well, you got consumers with more money in their pocket to spend on other things, right? And you got to understand, consumer spending is about 70% of our GDP. So when they've got more money to spend in other areas, that's obviously a good thing for our economy. The only thing I could say was bad is it was kind of a double whammy when it was happening alongside the coronavirus. But hopefully this gives you an idea, when it happened, how it kind of affects our market.
Hi, folks. I hope you found that valuable. Listen, when I was talking about systematic risk, if the market is trending upward, most generally, if you're bullish on the market and you believe it's going to be trending upward, then some of those kind of accounts that are like index funds can serve you very well. Because if the market's going up as a general, mostly a lot of the stocks are going up along with it. So they can serve you very, very well. But if you go into a bear market or a market that's on a downturn, most generally, then sometimes these accounts can hurt you because you're basically passively invested. You're holding a basket of securities or this index account, and if market's trending downward, and people are selling off those accounts, a lot of those stocks are going to be going right down along with it. So may serve you well in an up market, may not so much in a down market. And just understanding how that account or that index fund is going to act is going to be important. So nothing bothers me more, and I find this a lot. You've got that stock in your portfolio, it might be your favorite stock, and you're looking at the market that day, you see that it was down, you go into your portfolio, you look and you see that stock was down. And for no apparent reason, other than that everything else was down, it went down with it. So nothing's more discouraging than that when you see that. And then folks, when I was talking about the effects of low oil prices, I've seen a lot of oil companies are different, as far as their, where they make their profits and how much, it really a lot has to do with their costs, right? But I heard a long time ago that, for the most part, as a general, oil companies need to see at least $50 a barrel to, begin to make money because of their costs. So, we've seen quite a long time during this pandemic, oil prices be very low. For companies that are oil companies that are highly leveraged, they can't sustain no profitability for long periods of time. And so that makes them very vulnerable to, maybe the company going bankrupt or whatever. So I would dare say, as much as I like seeing low oil prices at the pump, during that pandemic where I was doing very little travel, filling up my truck very few times, but even when I did, it wasn't costing me that much. That was very pleasing. But I don't want it to be at the expense where the oil companies can't make money. We want a careful balance there, right? We want them to be able to be profitable, to continue to produce oil, but keep it at a low price for us so we can enjoy that at the pump. So I don't know if you saw this during the pandemic. A real odd situation happened where actual oil prices went negative. A lot of people, a lot of these companies that need oil, they buy futures on the market, and so they want the oil. So it's just a matter of what they're going to pay to get it in the future. But then you got speculators that are in the market, and they don't necessarily want the oil delivered to them, right? So but they're just kind of speculating on the price. Well, with that pandemic, everything demand had dropped off so fast, and these people that were speculating in the market were looking like they were going to have to take delivery of this oil, and they did not want it. So they were paying people to take it off their hands, and that's how it kind of went into negative territory. Really weird situation. We haven't now seen it since that time, but it was quite interesting to watch. So anyway, stay tuned, because next I want to talk about the 7 mistakes people make when choosing an advisor, and then I'm going to talk a little bit about orphan accounts and what they are. So stay tuned.
We here at Centennial Wealth Advisory realize that everyone has been affected by this coronavirus in one way or another. We watch our retirement accounts drop significantly in value, and we have questions. Can I retire in a recession? How will the coronavirus affect my retirement? How do I develop an income stream in a recession? Can I still retire this year? If these are concerns of yours, contact us today for a free initial consultation and learn what you can do now to help you weather the storm. Simply call 888-608-5825 or visit sunwealth.com and let us help you plan to retire well. Seven mistakes you make when choosing an advisor. Number 1, not picking an advisor that's a fiduciary. Now, a fiduciary is just somebody that has to act in your best interests, okay? Obviously, everybody wants that kind of an advisor, you would think, but not all advisors are fiduciaries, so that's number 1 mistake. Second mistake you make is just hiring the first advisor you see. If you're looking for an advisor, you're looking for somebody that you connect with, that you're going to trust, then I would dare say I would visit more than just one. I would maybe see 1, 2, or let's say 2 or 3 at least, just to get a feel for, the differences with advisors, to pick one that might be a better fit for you. Number 3, choosing one with the wrong specialty. Now, if you go to an advisor that just sells insurance products, what do you think is going to be the answer to all your problems? Insurance, right? If you pick an advisor that's just selling stocks, bonds, mutual funds, what do they think is going to be the answer to all your problems? You guessed it, right? So you're going to want to understand, if it's somebody that's more independent, that can sell a vast array of financial instruments, might be a better fit for you. Number 4, picking an advisor with an incompatible strategy. If you're picking an advisor who works really well with somebody that's in the growth and accumulation phase of their life, they're working and take on a lot more risk, and yet you're somebody getting soon to be retired or retired, that advisor might be incompatible for you, because they're looking at more growth strategies when what you really need is more preservation and wealth. So picking an advisor that's got an incompatible strategy. Number 5, not asking for credentials. That's very important. You see those commercials on certified financial planners and how the guy ended up being a DJ or disc jockey, and they were going to put all their money with this person. What kind of credentials they have, but even most importantly, what kind of experience. Has that person been in the business for quite some time? More likely, if they've been in for 20 years, they've experienced the last 2 market drops, and maybe they're going to be, that experience is going to, help them in making forming a better strategy for you, and also knowing what's out there and what's available. Number 6, not understanding how they get paid. People want to know how people get paid, and it's very important. Are you paying too much? But transparency is a real key to that. Number 7, not getting references. Now, a lot of advisors, they can't give you testimonials. That they're not allowed to do that. They can't post them on websites. But they can get permission from some of their clients to allow their name to be given out for referrals. So sometimes if you just want to see how a person's operating with others, ask for those referrals. And I'll give you a bonus mistake, not calling me. I encourage you, if you're somebody that needs an advisor or just wants a second opinion, call Centennial Wealth.
Professional quarterbacks have a game plan. Passing the ball with power and accuracy is vital, and good communication within the team is key. As you can see, we aren't professional quarterbacks, but at Northern Michigan's Centennial Wealth Advisory, we are professional financial advisors. And just like a good quarterback, we have a game plan, a holistic approach for your financial future. Using income planning, tax planning, estate planning, wealth management, and healthcare planning to help you plan to retire well. We have lived in Northern Michigan all our lives, and we have offices in Traverse City, Gaylord, Petoskey, and Cadillac. Give Centennial Wealth Advisory a call or visit us at cen-wealth.com and let us help you plan to retire well.
So what is an orphan account? Folks, this is just simply an account that you might have out there that you don't have an advisor associated with it anymore. If it's an insurance product, maybe it was life insurance, maybe it was an annuity, there was an agent some time ago that sold it to you, and you see his name listed as the servicing advisor. Well, what if he's no longer in the business or he's no longer with that company? You could very well find yourself an orphan account in that regard. What if it's managed money or mutual funds that you were sold, and again you had an advisor, he's listed on the statement, but now all of a sudden he's not associated with that company anymore. A lot of times you'll find they'll just reassign you to somebody else, but in that particular case, you've got an advisor of record, but the advisor isn't servicing the account any longer. I would recommend or encourage you that if you find that to be the case for yourself, then you're going to want to get an advisor associated with it. In regard to any kind of insurance product like life insurance, annuities, all you have to do is find another agent that's got an assignment with those companies, and with just a simple letter of instruction, you can have them be the servicing agent on that account. They don't necessarily have to be the one that sold you the instrument. Same thing with a mutual fund account. You just have to find an advisor that's got an assignment or can sell that company's products. Letter of instruction or some forms allows them to be the agent of record, allows them to service that for you. Now, some insurance companies I know, because I get these calls, will call me when an account becomes orphan. They'll say, hey, listen, so-and-so is no longer in the business. You're an agent local in that area. Would you reach out to these people and see if they would let you be the agent of record? So we know that client, that customer is getting serviced. You may be an orphan client and don't even know it. When's the last time you talked to the advisor who maybe sold you that financial instrument? If it's been a number of years, you might want to check on that to see that they're still there, they're still able to service that for you. The reason you want to get an advisor involved as well is because, what if it's managed money? Wouldn't you want them advising you as to, what you should do? Maybe you want to change course with the strategy. If you're just passively invested the way he or she had you set up, then, maybe there's a change that needs to be made. If it's a financial instrument like an annuity where it has these interest crediting strategies, where's the advisor advising you year after year on making any changes? I think people basically prefer a face-to-face meeting, so all the more reason that you're going to want a servicing advisor that's local, somebody you can go visit to and talk to. So I encourage you, if you're somebody that's an orphan account, give us a call. We've got a lot of assignments with insurance companies, managed monies, mutual funds. We could be of help to you. So if you suspect you're that person or are, give us a call.
Hi, welcome back. Folks, when I was talking about those mistakes people make when choosing an advisor, probably the most common one I see is that one that I was telling you about with an incompatible strategy. You've got these people that have had their advisor, they've maybe liked this advisor, maybe that advisor has done them a great job in the accumulation phase of their life, but now they're getting near retirement, in retirement, and they want to take possibly a more conservative posture, because now they need that money for income. And that advisor is still, strategizing the same way they did before. And so I think that's a time when you're going to want to kind of sit back and say, and ask that question to that advisor, hey, are you willing to start making the transition here? Or are we going to kind of continue the same strategy all through retirement? And then when I talked about experience, it is so very important. What you want to know is, how long that advisor's been in the business. Have they seen a couple market corrections or bear markets before? And what did they learn from them? And what are they applying now to your strategy as you move forward? If you've got somebody that's never experienced a market downturn, are you going to be concerned that maybe they're not strategizing accordingly, acting as if that can never happen? Of course, you're going to want to know that. So always check that out. And then just how advisors get paid. Most people don't care that the advisor gets paid. They understand it's a business. But a lot of times they just want to know how, so I think transparency is going to be very huge. And then regarding those orphan accounts, I was trying to stress the importance of, having an advisor associated with your account. You can deal directly with the company, but understand, that they don't have to give you investment advice. Matter of fact, they won't give you investment advice. They have liability if they do. So if you need a distribution, you got a question about the mechanics of your particular account you have, of course they can answer those questions, or they can service your account accordingly. But the minute you say, hey, what fund here do you think I should go into? They're not gonna tell you, because there's liability associated with it. That's when you want to have an advisor on your account to be able to answer those kind of questions. And again, I never like to see these accounts. Time and time again, I'll have somebody come in. They've got this account. They haven't talked to the advisor in years. The advisor might even be associated with the account any longer. And maybe they've got some sub accounts, or they're invested in such a way that there's been no change since they initially maybe bought the product or got involved in it. And I just don't like to see that, because, at times there are changes that are necessary, adjustments that need to be made, rebalancing, reallocations. Of course there are. So, I just can't stress enough, if you've got an account and you have not talked to an advisor in quite some time, or don't even know if your advisor is involved, give us a call. We'll be glad to service that account for you, make sure that you're being serviced appropriately, and getting the advice that you need. So anyway, thank you. Stay tuned, because in this last segment, I want to talk about these ABLE accounts. They're mostly for special needs people, but I think it's important for you to know, because there's a lot of people out there that might be happy to know about these. So stay tuned.
What are these expense ratios you find in mutual funds? Most importantly, how much risk can you take on? I want to talk to you about Social Security, the estate tax exemption, Lady Bird deeds. What are they? Modified adjusted gross income, tax bracket optimization, the sunken cost trap, 529 plans, the financial cycle, the Federal Reserve, income planning, tax planning, holistic planning, fees, bonds. Can I retire? Okay, in this segment, I want to talk about what's called ABLE accounts, A-B-L-E accounts. Okay, now these are 529 counts. Now 529 is just the IRS tax code number for when this account got created. But it stands for Achieving a Better Life Experience Act. Okay, now this is for disabled kids or people that you want to, that can have savings. And let me just explain some of the details. First of all, anybody can save for a disabled person. It could be a grandparent person or unrelated person. So anybody can save for this disabled person. Now, the disabled person has to have been diagnosed with this disability before the age of 26. Okay, so it's not for somebody that got disabled after that age. They had to have been diagnosed before the age of 26. Now, that person that's disabled can still be receiving SSI, Social Security, and Social Security disability. Okay, and they can still have this savings, and this savings does not count against that income. Okay, if you have a disabled child or know somebody that's disabled, you know that they can only have so much in their account and before it starts to affect, their Social Security disability. With these ABLE accounts, they're able to save up to $100,000. Okay, and that $100,000 can be used for anything from medical to education to tutoring and all kinds of things. So this is a great way for somebody to save, have a lot in savings and have it be there for them somewhere down the line and not affect their disability. Now, when you put money into these accounts, there's no tax deduction for doing so. You're limited to the annual gift exclusion every year. Right now, as of this airing, it's $15,000 that you can gift somebody without having to file a gift tax return. So you can give up to $15,000 per year and save up to $100,000 in these accounts for that disabled person. Now, it used to be to have an account like this, so you had set aside for that disabled person. We had to use what was called a special needs trust. And basically how those work, and matter of fact, you can still use a special needs trust if you find it appropriate. But what they do in these trusts is it's an amount that you can have there for the disabled person, but it's not, they don't own the assets in it. So the money can be used for their benefit, but it's not in their name, so it can't count against them for SSI or disability. So in some cases, these ABLE accounts might be useful. If it's going to be less than $100,000, that'd probably be the simpler way to do it. But if you obviously you wanted to save a lot more for this disabled person, let's say it's an inheritance or something, you're probably going to want to use a special needs trust, which means you're going to be talking to an attorney to set it up. So hopefully you found this valuable. It's a lot of people out there don't even know these accounts exist. So if you do have a disabled child or know somebody that you want to put some aside for, then obviously this is something you might want to do. If it's an account you want to set up, give us a call. We'd be glad to help you with it.
Hi, welcome back. Listen, ABLE accounts, the reason I just wanted to get the information out there is because there's a lot of people that just don't know about them. And, I personally, I have a half brother with special needs. And so, this is something that I very much wanted to know about. And when they first came out, it didn't come out with a lot of publicity. So if you're somebody that, knows somebody in your family that's got special needs and you want to help them or provide for them, maybe you're the parent of that special needs child, and here's a way they can save accordingly. So anyway, hopefully you found that valuable. Folks, I can't say it enough that if there's any help you need with any of your financial planning, whether that be estate planning, income planning, tax planning, healthcare, long-term care planning, wealth management, give us a call here at Centennial Wealth. We'd love to meet with you. I'd love to see if we could help in any way. So hope you found this valuable. We'll see you next week.